Are we headed for a recession, or are we already in one? Well, the experts are telling us yes, no, and maybe, so we gotta get prepared. Sorry about that. There's a lot of confusion here, and in this video I want to show you why. But first, I have to let you know that what sets the interest rates on treasuries, the yield, is a bunch of investors trying to calculate risk. It's much riskier to loan your currency to the government for 30 years than it is for just 30 days. So investors almost always charge more for the long-term loans to the government than they do for short-term loans. You can sort of predict what's going to happen over the next 30 days. It's really hard to predict what is going to happen over 30 years. So the bellwether, the thing that analysts look at most to try and predict a coming recession, is the yield on the 10-year Treasury minus the yield on the 2-year Treasury. And whenever that inverts, when it goes negative, that has historically predicted recessions. So when investors are charging more for a short-term loan to the government, they're seeing something in the economy just around the corner that might be risky, and so they want that extra return, and it pushes it up above the longer-term loans. And so what you see here is that since 1976, 6 out of 6 times, this has accurately predicted a coming recession. And I say coming recession because other than this one where it just dipped down for 1 month or less, but it did go negative and it predicted the pandemic recession. That one was only a 6-month delay. But typically, this is somewhere between 1 and 2 years. There's one here that is 13 months and one here that is 23 months. And so it says that a recession is coming, not that it's already here. Well, this just dipped down negative just recently. So it isn't saying that we're already in one. This is the thing people look at most. Now, why is it that investors and all of these analysts and everybody, they can't come, unlike blockchain, they can't come to consensus. They are literally saying, yes, some of them, no, some of them, and maybe some of them, and some of them just don't think there's ever going to be a recession again. I don't think that is quite likely. But there are other predictors out there. Here is the 10-year Treasury minus the 3-month. And I really wish this data set went back a lot further. This one only goes back to 1982. But look at how accurate this is, and it predicts it much closer to the recession. So it's sort of a confirming indicator if the 2-year minus the 10-year minus the 2-year is also being confirmed by the 10-year minus the 3-month, then yes, it's most probably going to happen. This has not confirmed yet. So we don't know that there is a recession in our future. But there is more. This is the 10-year minus the Fed funds rate. And what you see here is this goes all the way back to 1962. And so there is 1, 2, 3, 4, 5, 6, 7, 8 recessions in here. And it did predict it. 8 out of 8 times this went negative before the recession. However, there are a lot of false flags in here where it said that there was a recession. So you can only use this for a confirming indicator. And it is definitely not confirming. It's nowhere near saying that we're going. Now, 8 out of 8 times, if this was used as a confirming indicator, before the recession happened, it did predict it. It said, yes, the 2-year minus the 10-year minus the 2-year was right. The 10-year minus the 3-month was right. The 10-year minus the Fed funds is a confirming indicator that should go negative before we actually go into a recession. But wait, there is more. This is the 5-year minus the Fed funds rate, and the same thing. 8 out of 8 times it has predicted a recession, but with a whole lot of false flags. And look at this. It went negative so much, predicting the pandemic plunge, the COVID crash, the recession that was caused by a disease when the disease didn't exist. This is really, really interesting. And so here is the 1-year Treasury minus the Fed funds rate. And actually, there's not much information to glean from this, because there's so many false flags. But it does tend to go much more negative just before a recession happens. So it can be used as another confirming indicator. Even during the, predicting the COVID crash, it went negative. But it is nowhere near negative today. So taking a look at this from a different view, this is today on the dynamic yield curve from stock charts. And what you see here, the 10-year is lower. It's inverted with the 7, the 5, and the 2. The 7 is inverted with the 5 and the 2, and the 5 is inverted with the 2. But we are not yet at a point where we're inverted with the 3-month. Now, let's go back and look at some previous recessions here. The one right after the crash of so we've got an inversion of the 10 and the 5 and the 2. They're all inverted, and there will come a point where the 7-year is also inverted. But now look at this. The 3-month gets inverted with all of them. The 3-month is much higher than the 2-year, the 5-year, the 7-year, or the 10-year. It's even higher than the 20-year. So that was already during the market crash, and a recession shortly ensued. And then we go up into the peak of the real estate bubble and the insanity of both the stock market and the real estate bubble. And we're getting an inversion of the 3-month with the 2, the 5, and the 7, and then the 10. And then it goes back, and then we go into the recession. It happens after these inversions. And so here we're seeing, we came up on this a month or two ago, and now we're seeing the inversion of the 10, 7, 5, and 2, but not yet with the 3-month. And like I said, this is a predictor of what's coming in the future. So we probably aren't in a recession, but every recession is different. Otherwise, they would be able to accurately warn you of when they're coming. The reason they're different is every one of them has different levels of GDP contraction, employment levels, and inflation. And so that's what makes every one of them a different story. That's what makes them so hard to predict. So getting back to the 2 and the 10-year, this is what most analysts use to predict a recession. And yes, it is flashing a warning sign. But there are a whole lot of confirming indicators that have yet not lined up. I want to thank you for watching. We'll see you next time.